Hello, this is Brother Kimball. I'm just going to do a quick introduction to this Module 1 worksheet. In this first Module 1.1, you'll be learning about what are equity investors and what information they use to make investment decisions. You would have already learned that the balance sheet equation is assets equals liabilities plus equity. You also learned what type of different investors are. So in this first one, we're going to ask you, based on the information given, are these individuals debt or equity financiers? Remember, a debt financer is someone who has lent money to someone else and expects to be repaid, usually with interest. An equity financer gives money to the other individual or business and becomes a part owner. So hopefully that will help you in making that decision. Number two, this is about the balance sheet equation, and all you have to do in this case is use the concept of what are assets and liabilities and equity. And the basic idea is all of your assets are either funded by debt or by equity. So if you know your assets and you know your liabilities, you can solve for equity. And vice versa, if you know your liabilities and equity, you can solve for assets. And if you know your assets and equity, you can solve for liabilities. Number three, this one is similar. Similar to number two, you just solve for two of the three, and you put in two of the three items and you solve for the third. Number four, net assets is the same thing as equity. So once again, if you've been able to compute equity, that is the same thing as your net assets. Number five, assume you purchased $1 million of stock in a company and sold it 3 years later for $5 million. Whenever you get back what you originally invested, that is a return of your investment, and any excess you get back beyond that is return on your investment. Now, if you get back less than what you originally invested and you're done with the whole investment, then all you will have had happen is you got a return of your investment for part of what you originally invested, and you have lost some of your investment. Okay, moving on down. In 6 year, how do they expect to receive a return on their investments? Now that was in the video. I'm going to let you, refresh your memory. You should know that. Okay, Module 1.2, what are creditors and what information do creditors use to make credit decisions? In this one, what I'm testing you on is to see if you can read this and ask yourself, what is it doing to the balance sheet equation? For example, let's look at this first one. You borrowed $1,000 from the bank, okay? So think about your assets, liabilities, and equity. If you borrowed $1,000, what will that do to your assets? What will it do to your liabilities? What will it do to your equity? Now, we don't have to worry about this interest because that's going to be incurred over time. So all I'm talking about is on this first day, what will it do to your balance sheet equation? So each of these I want you to look at and say, what does this do to my balance sheet equation? The second one, these terms right here may not be familiar to you. Payment terms, like when you buy on account, your seller, your supplier, will give you what are called payment terms. How you translate this is you will get a 2% discount if you pay off the whole bill within 10 days. Any amounts not paid off within 10 days, you have to pay in full within 30 days. Okay? So 2%, if you were to pay in 10 days, you would knock off 2% of this $500. Okay. Now, once again, we're only worrying about the first day, so we don't have to worry about whether they did or didn't pay. We're just saying, on this day, what did this transaction do to your assets, your liabilities, and your equity? So go through each of these and just try to imagine that. Now, this fourth one seems maybe a little difficult. In this case, you're going to earn $2,000 of net income. Now, you have to think, who owns that income? And that's going to be your owners. That's going to be their equity. And this income will increase your assets. So think about it that way. There's no new liabilities just from this information given here. And then if you distribute $200 to each partner, you got to think, I'm giving up assets. And the owner's equity will go down because they're distributing their equity out to themselves. Okay, so that one's a little challenging, but the goal is to get you to think about it. Once again, the solution is already available in the course. So if you get really stuck, do your best first, but if you get really stuck, you can check against the solution. Okay, let's keep going. Trying to go down. Here we go. Okay, you've learned how to compute interest. That's principal times rate times time. So you should be able to compute how much interest will be owed after 3 months. And the principal is the original amount borrowed, so that should help you there. If you were to pay off the loan in full 12 months, obviously you'd have to compute interest for 12 months, which you'd pay on top of the original principal. Okay, 1.3. What are managers? You have these 4 friends you want to report. And this is testing your understanding of the difference between financial and managerial accounting. You should know that based on the video. Number 2, you have this ad campaign that's being proposed to you. We're trying to make a decision as to whether this is a good campaign or not. This is using the concept of cost versus benefit, which I discussed in the video. Oops, I just gave you the answer to number 3. Anyway, number 4, name the 2 primary user groups of financial accounting information. Okay, we talked about those 2 user groups, and you've noticed those above. And then number 5, what organization is responsible for creating the standards and rules for managerial accounting? That was also discussed in the video. So I think the videos provide you sufficient information to help you answer all these questions. Once again, the solutions are available. I hope you refer to those as needed. Aloha.